Good afternoon. The snow stopped. What's up, Bandit? Bandito. What's up, Francisco? 87 in Boston? It's 28 here. Degrees. What's up, Ricky? What's up, Kyle? What's up, Ramon? 89 in NYC. Ugh. That sounds terrible. I don't want to be there. 79 in Chicago. We can deal with that. Here, when we've been getting into the 40s here these last few days, it's been like incredible. It's 42 degrees the other day. I was just walking around in a t-shirt. It was awesome. Get out of town. All right, let's jump in. If I'm blurry at all in the VTF, just go to the YouTube. I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Wow, really blurry on the VTF there. Today is April 13th. Thursday? Thursday. There's the position disclosure. I got out of Microsoft. I got into Roku. Or did I have Roku yesterday? I don't remember. I think I was out of both Roku and Shop yesterday. I got into them today again. Chevron, new swing position. So I think I'm in 18 swings. Oh man, what a difference a day can make. The PPI number coming in light changed everything. I was really nervous at yesterday's close. I was really concerned at yesterday's close. Yesterday we had a negative Marubozu, kind of an engulfing candlestick for the market, especially if you look more at like the IWM failure off resistance, or if you look at that QQQ candle closing like right at or actually just under support. I thought it was a warning signal. The intraday volatility that we had yesterday, the fact that we sold that CPI number, I was under the impression, so we didn't do an afternoon meeting yesterday because Scott Ruther had his conversations with a pro trader thing going on. Scott Ruther, by the way, seems to think he can beat me in a push-up competition, but he's just going to lose again. But anyway, we didn't do an afternoon meeting yesterday, so we can recap a little bit of yesterday and recap some of today. I was really nervous, technically, at the close yesterday, and even a bit pre-market this morning before that PPI number hit, which really helped the bulls out. Yesterday, the number was pretty much in line, slightly light on the headline CPI number. I'm still under the impression when I look at positioning right now. Sentiment has actually turned a little bit more bullish. If you saw Pat's note from this morning, where is it? Let me pull it up. If you saw Pat's note from this morning, this chart, where is it? This fear greed index is back into the greed zone. I feel like it's the first time I've seen that in a while. Curious to know when the last time was. I guess everything above like 60 is there. So we're back kind of into the greed zone here on this fear greed sentiment indicator, which is interesting. I think that you broadly start looking counter on this indicator, counter to the market, when you're in the extreme category or not in the extreme category. February 1st was the last extreme greed reading. Thanks for that information, Pat. And we also had a little bit of a top shortly after that. And I know it's bigger picture than like that short-term tactical sentiment that we like to look at. But notable that's in the green situation, but the greed situation, even though that's in greed now, all the data I'm still seeing shows that market positioning is still not really prepared for the upside in this marketplace. Hedge funds have really increased their short exposure. There's still a ton of people that are out there in cash and obviously in money market funds There's been people who have been trying to make an argument that there's like a bubble happening in money market funds right now. So when I saw that inline number yesterday, and I combined it with the bullish technicals that the market was presenting itself in that initial upside move, I was aggressive yesterday. I was aggressive to the long side early in the day and got burned for it. Yesterday was, if you don't include my SVB loss, yesterday was my second worst P&L day of 2023. And I'm fine with it. I'm fine with it. I was aggressive. I followed my game plans. I did what I wanted to do for the most part. Maybe I was a little bit too aggressive in some areas, but I did what I wanted to do. And the market proved that my thought process yesterday morning was incorrect. I'm looking at that CPI number coming in line to a little bit light. I'm looking at the market's initial reaction to it, which was very bullish. I'm looking at our daily chart market technicals, which for the SPYs and the Qs are incredibly bullish, but were no longer extended yesterday after, pretty much 5 days of kind of time and price correcting here. This market just completely going sideways. SPYs are looking ready to go on that daily chart yesterday morning. Qs, same thing. What I've been calling for is Qs giving sideways action here in April and allowing the IWM to catch up. For the most part, I've been getting that. Qs just pretty much resting for the entire month of April so far. The 21 EMA is caught up. You've got this really strong base around 313 for the Qs. The IWM, still a little bit of a wild card. We still want to see more of that mean reversion. We want to see some IWM leadership. 180, I mentioned, big resistance level in the IWM, and I think we topped out there pre-market after the number at about 180. But still, not. This is looking to me like it could go potentially also and could break out through 180. So I'm just looking at that number, combining the fundamental thesis, my understanding of what market positioning currently looks like, and these market technicals, which is what my approach is to markets, and it had me be I went for it. One of the big things that I always try to emphasize to traders is to know when to be aggressive and to know when to be passive. To know when there's a ton of opportunity out there and really go for it, and also to know when you don't have as much of an advantage and to take a half step back and not trade nearly as aggressively. And yesterday I thought was one of those days where you got to go for it. We got a CPI number. We've seen how CPI numbers have moved markets in the past. It can do it in a really big way. I'm combining that with bullish technicals, but bullish technicals that are not extended. I'm combining that with market dynamics right now that I would also argue are really bullish. So I totally went for it. And I actually had some pretty good executions at certain points on some of these lows. But the market failed. The market didn't fail on this initial pullback, but the initial pullback was very heavy. Oh, and on top of that, my other idea was wrong about tech outperformance. I thought tech would outperform on that CPI coming in a little bit light to inline. I thought that would create a little bit of an easing impulse, and tech could potentially lead. I was also very, very wrong with that. The Qs were extremely weak yesterday, whereas the IWM obviously was also weak, but held up a little bit better for most of the day. Again, I'm still looking for overall mean reversion, IWM catching up to Qs. But like I've been saying repeatedly for weeks now, it's not going to be an everyday phenomenon. There will be individual days where the Qs are still able to outperform the IWM. That's actually what I was also expecting today. Today I was correct. Yesterday I was not. The Qs were atrocious. But that initial pullback was fast, hard, and violent. But the SPYs, if you look at pre-market from yesterday, were barely able to hold above that opening low of the CPI news event. So very broadly, I always say from a small time frame, you're better off being long than short as long as we're holding above the news event if the initial news event was a positive reaction, and then you're better off being short than long if you lose that low, because then you got a lot of people that are out of the money, and that's obviously on a very small time frame. You got to combine your other layers of probability, your extension, what the big picture of the market's doing, etc. So I had a pretty good long here, and the really interesting thing about yesterday, there's a ton of volatility, a ton of intraday volatility. I think more than we've seen in a while. We had 3 major intraday sell-offs and 2 major intraday recoveries. That's a lot of price action for one trading session. You had that opening sell-off that barely held the CPI low. And I would argue, and I said this briefly in the morning meeting today, but we can analyze it a little bit further, this snapback off that low was more than it should have been if bears were going to be maintaining control. Fine, you get this huge 4-bar down move. It was especially pronounced in the Qs. First 4 bars down big. I think I called out a long, yesterday into lows at that 945 bar just for an oversold bounce kind of trade. And that oversold bounce exceeded expectations. It wasn't just a bounce like into equilibrium or, bouncing, maybe you bounce back to like 411.23. We got above the high of this higher volume 5-minute candle and stabilized above it. So things all of a sudden are looking good. Like, okay, wow, like they sold the gap initially, but we regained market composure here for bulls. We're holding above these small time frame moving averages. We're consolidating a little bit. We're possibly setting up for a next leg higher. And then just as the technicals look like, wow, we have a recovery in place on this small time frame, bam, we got our next failure. Next big leg down hits starting at 10:30. I'm trying to remember if another number came out or something at 10:30 that caused that, and I honestly can't remember. So much going on over the course of the last 2 days. But then 10:30 hits, and that's the real failure, right? When we lose that opening pullback low, and that opening pullback low was more than you wanted it to be, when you lose that opening pullback low, you're also losing the CPI low for SPYs, definitely for Qs. I think maybe this IWM was trying to show some relative strength and still hold in. But at that point, this market is not looking good. And any bullish thesis that you have, like I had, is kind of out the window at that point. We got another opportunity for an extension long here at 10 after 11, but that was the same thing. It was just a bounce trade. I'm not expecting, fine, I'm seeing 4 big down bars in a row. The 5th bar here gives us a hammer. I wish this hammer was on a little bit higher volume. It's also like that 5-minute RDR trade that I've been talking about a lot. And we get this snapback, dequilibrium, exactly what you're supposed to get. But then it gives a full small time frame reversal. Again, this second recovery from this massive sell-off was way more than it should have been if bears were going to maintain control. And then we even got back above that CPI starting point again. So when you start seeing this market stabilize between 12 and 2 o'clock when we had FOMC minutes hit, you're like, wow, we were able to do it again. Really impressive. Bulls were able to recover this market. FOMC hits. First 25 minutes go by, things are looking fine. I mean, even particularly, I remember this 2:10 a.m. candle. We're looking great after this 2:10 a.m. candle. It looks like after some volatility, we might want to even begin to start to resolve to the upside, whether that's because of the FOMC minutes or it's just because the technicals themselves at this point were bullish. I don't know. But then just after that, I still don't fully know what happened here at 2:25. I know there was a headline out of the EU that is getting the credit, if you will, for this sell-off into the close. I didn't think that headline out of the EU was anything that was contrary to expectations, and it's usually only things that are contrary to expectations that kind of create those really larger moves. So maybe it was just, I don't know, a combination. The only language in the FOMC minutes that was maybe a little bit scary was when they were basically predicting some sort of recession to come in the second half of 2023. And yet the market held in for 25 minutes, but the combination of that, I guess that EU headline, whatever it is, we got our third failure. And when this third failure really started to happen, I was like, in my brain, I was like, man, we recovered twice more than we should have. The probability of a third recovery is not good. And furthermore, given all this volatility that's starting to come into the market, that begins to feel a little toppy, if you will. And the fact that we're then able to have this CPI that I viewed as generally good news, but have us close on lows like that, and then give a daily chart candle where you've got this negative Marubozu that's kind of like an engulfing type of candlestick, I was really expecting that we were going to get further downside follow through. I was like, all right, there's the signal. The bigger correction is happening, which is no real surprise. I mean, that's what we've been seeing if you want to be really big picture if you can go all the way back to May of 2022, we've just been in a massive range with a lot of volatility since May of 2022. So guess what? We get into the top of the range and we're giving a signal of failure. That's no surprise. I don't like the degree of volatility in conjunction with the close on lows. I am recognizing that the technicals on the big picture are still intact. You know, your SPYs here, I mean, we just got to pull back to the 80 MA on the daily. It's no real big deal. The Qs were kind of barely holding on to this important 313 support. Our closing price yesterday was 313.04. But the 21 EMA is there, so it's like kind of still intact, but this candle's looking no good. And then the IWM just had made all that progress to get above 178, tested 180, and then closed back below 178. That's also not looking good to me either. So I'm like, all right, you know, market technicals here are giving me a warning signal. It's a big flashing yellow light that's telling me I need to slow down a little bit, really make sure I got my risk managed, that I'm not over leveraged to the long side or whatever it is. And I kind of still went home uncomfortably long, given that situation. You know, I don't really, and I got an email from someone that I haven't had the time to respond to yet that was asking me about hedging. I don't really hedge into the close like that when the daily chart technicals are still bullish, even though I'm potentially concerned. I prefer to hedge, you know, big upside extension, which you guys have seen me do a lot when we've had those real big moves. Like the last time I was really starting to hedge myself out was April 3rd, April 4th, and then we caught this 2-day pullback with a lot of, you know, TQQQ short, short one of the, maybe it was UPRO, I think it was UPRO that I was also short into kind of that move that paid pretty well. So I'm just kind of concerned, but I follow my game plans. So I know where my swing positions are. I know where my stop losses are supposed to be. I know how I'm managing risk on every position that I'm involved in, and it just kind of is what it is. You know, you can't, and I say this all the time, you can't truly maximize reward if you're not willing to give back open profits. I think just 2 days ago I did a whole afternoon meeting about, you know, this is how you can start in a position, and you know, I don't remember what name we were looking at, but this is how you can start in a position, this is how you can get some stock, and it doesn't have to be very often. It can be a low probability situation, but you come in this trade and you risk, and I really don't remember what name we were looking at, but you come in and you risk, it might have been Schwab when we were talking about that. You come in and risk 50 cents there or 25 cents somewhere else, and then maybe you get that really big move on that daily chart, even if it's lower probability, that actually gives you 100x your risk. Those are the moves that I really want to get, even if it's a lower probability of happening. And it'll never happen if you're not willing to give back open profit. So I got my game plans in place. I'm very concerned to see that, you know, the market's closing at lows with a bearish engulfing candlestick, that we sold that number, but it just kind of is what it is, to be totally honest. Like I mentioned yesterday, and partially because of giving back P&L and swings, but partially just because I was particularly aggressive yesterday morning. Yesterday was my worst, or second worst P&L day on 2023. The good news is that today I made even more money than I lost yesterday, and that's exactly what you need to be doing, right? So just when I think things are not looking great, I'm expecting a gap down this morning. We actually gapped up small pre-PPI, and that PPI number came out, and wow, that came in really light. That was like probably one of the bigger misses on one of those numbers that we've seen in quite some time, and it just strikes me as very bullish. I was a little bit concerned that maybe, you know, they sold the CPI that I thought was decent. Maybe they look at, you know, PPI being such a big miss to the downside as, you know, recession, slowing economy, and that they still sell us down. I'm still competing with the fact that we've got this negative Marubozu. So what I really wanted to see off the open from this market was if we could recapture some key, like, intraday levels from yesterday that would also correspond with a decent percentage bounce back of yesterday's move. I said the ideal situation is that you just negate yesterday's negative Marubozu. And by the way, the rarest way in which a Marubozu gets negated is immediately by another Marubozu, which is what we had happen today. We had this negative Marubozu that puts the market in the penalty box, followed by basically a positive Marubozu that 100% evaporated yesterday's candle and got us back above it. That's the rarest way. Usually you need, this candle signals further price correction, eventually you can get a hammer or you get an RDR that creates a pivot low, and then over time you can work your way back up. Or one of the other ways in which I like to see a negative Marubozu or a positive Marubozu, but in this case negative, get negated is through an inside and up. So pre-market this morning when I was analyzing that PPI, I was like, well, that's pretty interesting. Things are looking pretty good. I think that tech can outperform. That was certainly the correct idea. But all I wanted was like a bullish inside day today. I did not necessarily expect that we were going to fully, negate yesterday's candle just in one session. I just would have been happy if the SPYs could have closed above 410 today with an inside day. And that was the first spot I was paying attention to. We went sideways for an uncomfortably long time this morning with the SPYs and IWM not really participating with the Qs. But the spots I was looking at intraday where I could feel more confident in being bullish were SPYs getting above 410, Qs happened first, Qs getting above 316, and IWM happened last, IWM getting above, I think I was saying, was I saying 177 or 177.50? I was saying I don't remember now. I think I was saying 177 on like a closing basis on the small time frame, and then ideally you negate the breakdown candle from 2:25 p.m. yesterday, which is a little bit higher for the IWM, a little bit higher for the SPYs than what I was initially looking at. But eventually we were able to do it, kind of gave us the all clear signal, and then we just got upside continuation. And I mentioned at a certain point when this market was starting to break up here around 130, something that I mentioned in yesterday's morning meeting that did not happen yesterday but did begin to happen today, which is at a certain point you go back to that understanding of where positioning is. You look at all these hedge funds that are sitting there, net short, or at least that's what a lot of our data says, that they are, more short than they typically are. Well, all of a sudden you might see some short squeezing happening, and that could then be followed by performance chasing, and this market could start to really continue at a certain point. And I think we start to get that at 130. Like this acceleration into the close here to give us a really strong daily candle is impressive. So now at the end of the day here, you got these Qs, which were literally just threatening to break down yesterday, now actually beginning to break out after a long consolidation. You got these SPYs looking phenomenal, and at a certain point we might have to worry about upside extension, but we're not there yet. And the IWM actually gave an inside day. So the IWM kind of gave more of what I want, but inside days are fine. They can give us clarity. The Russell was relatively weak today, but that's what we expected. The one thing I mentioned with pre-market with the PPI missing that much is this concern of recession. So PPI missing that much, what does it mean? It means that the Fed potentially does not have to be as aggressive. They're getting an out, if you will, on inflation to some degree. Obviously, there's a lot more work that needs to be done. But this PPI also is potentially a signal of the economy not performing well. So what does that mean to us from a strategic perspective? Well, the easing impulse that can come from a strong TLT, which actually one of the most interesting parts about today, which we can talk about this in a second, is that the TLT was strong really early but totally rolled over. But I was looking at least pre-market after PPI with the TLT trading higher, creating an easing impulse, and a further weakening of the dollar today, also creating an easing impulse. What should that benefit the most? That should benefit tech the most. And if there are any concerns that PPI gives about the real economy, that will show itself in more of your average company that's out there. Not necessarily your tech stocks, but guess what? Your mid caps, your small caps, your IWM names. So that's where the idea of QQQ outperformance pre-market kind of came from. It turned out to be accurate. SPYs are giving an inside. IWM is giving an inside day. The inside day closed at about 178, which is an important level. I would describe that as productive. But bulls really want to see this IWM give an inside and up and start to regain some strength and then really go after that 180. So we'll see what happens with that tomorrow. Tomorrow we got basically, earnings season basically kicks off tomorrow. We got a few banks reporting in the morning. JP Morgan's reporting in the morning. So we'll see how that plays out. It's going to be really interesting to see these big banks' earnings reports post SVB. Obviously, the SVB situation only really began to affect those companies in early mid-March. So not the entire quarter, which is what those reports will be giving us, but it'll be interesting to see what they say as far as, you know, forward guidance and everything now that that has hit. So yeah, that's where we're at. So good day today, real good day today. So that's all I got. Happy to take a look at anything you guys got or any questions that you may have. All right. The first thing I think I'm seeing here is from Toussaint. I took a short on GFAI due to hitting some key levels like a 4 standard deviation channel on the daily and 3rd standard deviation on the 15-minute chart. Okay, I have no idea how that gets measured. I got in at $36 around $9.35. Well, that's a pretty good price. Obviously, you got massive daily extension. Massive daily extension. It's probably a BS company. I covered half at 9.45 because it was hitting the 9 EMA. Okay, that's fine. Then I covered another half or half of your remaining half at 9.54 at 32.70. I hope that wasn't getting all out. If you wanted to cover half of the half, meaning a quarter of the original position there, fine. If anything, and I see you're saying here, I got nervous because volume dried up. You're short. That's probably a good thing that volume dries up. But 1 minute later, 9:55, there was some super smacker sellers. Is that an official term? That pushed the stock down over 4 points. What are your thoughts? What goes through your mind when volume dries up early on the stock? Do you change anything about your game plan when that happens? So no. I have a game plan that I've established before I get in the position. I follow the game plan to the bitter end. It's too easy for us to get in our own heads based on information that doesn't potentially matter. You know, if you show me any trade, long, short, whatever, you show me any trade, if I really try, I could probably find one reason why that trade should fail. But for us, from a psychology perspective, it just becomes very easy to overly focus on that one reason why that trade should fail and forget about the 50 reasons why it should work. So for me, from a game planning perspective, and I think this is just really important from trading psychology, the best way to counter bad trading psychology is good game planning. And then you just got to follow your game plan. I think that game plans are also what breed consistency. I don't think that you can be a consistent trader if you change things on the fly. So I would say you want to have your game plan in place when you're entering the trade, and then you want to follow that game plan. For myself, if it was my trade, first cover is great. Second cover, taking a little bit more off, just to make sure it's it's going to be a real winner for you on what is a counter momentum trade is also fine. But your reward potential on this thing is a move to $20. And I'm just going based on where the ADMA is. There's also potential that your reward on this thing is down to $5 if this is really just a BS company that they're squeezing up, which could easily be the case. I would never call for a move to $5. I might be able to have a game plan in place where if it does go to $5, I have stock for the move. But having a real target of somewhere between $20 and $22 based on the daily chart, I think is what you want to have when you're putting that trade on. And it doesn't mean don't cover half to cover your risk. It doesn't mean don't take a little bit more off if you get a big pull. Or because this is a counter trend, counter momentum trade, just taking more off because you're getting into the moving averages, whatever it is. You want to have that built into your game plan on this sort of counter trend, counter momentum trade. But I think that you should try to hold some for the big move. The question is, if you kept your stop at highs, would you have gotten stopped out? Not that it matters, I'm just curious. 36.89 was that high. 36.83 is that high. Impressive that they didn't break that high there, but then it eventually closed at $25. So that would be my only feedback, is I don't think you should change your game plan on the fly. I don't do anything because volume dries up on a trade. I already have a game plan. Volume does tend to go down midday anyway. And keep an eye on that daily chart for where your reward potential is on some of your trades. Appreciate the question. from Kyle with Apple today. So I didn't go over any real individual names. I did my portion of the game plan, but Apple was one of the big winners from that kind of got mentioned in the morning meeting today. I really liked Apple long versus 160. PPI made it difficult to get stock versus 160. So I actually think the execution of Apple period was difficult. I haven't read your question.